And welcome to our live event tonight. And we're going to be discussing how to profit from the intersection of value, momentum, and quality. My name is John Bajkowski. I'm president of the AAII, and I will serve as the moderator tonight. Now, the American Association of Individual Investors is an independent nonprofit group, and we help individual investors become effective managers of their own assets through programs of education, information, and research. And really, the VMQ is an inspiration of our very speaker tonight, our great speaker tonight, Charles Rotblut. Now, you know, Charles is the editor of the AAII Journal. He's also authored the book, Better Good Than Lucky, and he's the creator and the mind behind the VMQ service. And welcome, Charles.
Welcome. And John, I think you deserve a lot of credit as well. We spent a lot of time discussing the various factors. So I think you co-creator rights are definitely well deserved.
Well, thank you very much. It was a fun project. And I know, you know, you've been at the association now for over 10 years. And, you know, when you first started, you actually had the Better Good Than Lucky kind of represented your best known knowledge and research behind what kind of quantitative factors an investor might use to profit from the market. And it kind of evolved. So what was, you know, what was the transformation? How did you go ahead and transform the process from Better Good Than Lucky into the VMQ service?
There was a couple of things. Certainly working at AAII, I've gained access to a lot of very intelligent people within the industry, and obviously my colleagues as well. Some research, but it was also a desire to really improve the screen I had been working on. And Better Good Than Lucky, I had a 10-point process for analyzing stocks, and one of them was really using price to book as a primary valuation criteria, which we still did. We still do at VMQ. But one of the things I was noticing is you had these stocks with low price to book ratios and high levels of intangible debt. And I also found a couple other times where I had stocks passing that I didn't necessarily want to buy. And so keep trying to tweak the screen to make it through this magical formula. I realized I lost sight of something I actually wrote in Better Good Than Lucky. And that's as investors, we do not need perfect stocks. It's okay if they have dents, dings, rust spots, so long as they're priced below what we can reasonably expect somebody else to pay for them. And so realizing I had gone too far in making the screen too restrictive, it was kind of the impetus I needed to go back to the drawing board and really look at what I'd done before and looked at all the knowledge I gained while working at AAII and come up with what I think is truly a better process for identifying potentially attractive stocks.
Well, it sounds interesting. It sounds like you kind of became, using a baseball analogy here, kind of a hitter that went from trying to swing for the fences all the time and striking out a lot to a person batting 400 and, you know, getting a lot of doubles and triples and scoring a lot more runs.
Absolutely. You talk about home runs. I think Babe Ruth is still ranked in the top 200 of all-time strikeout leaders in terms of striking out the plate. So while home runs are nice, sometimes you can be very effective hitting those doubles, singles, and occasional triples.
Well, I'm looking forward to your presentation, and I know that even though some of the formulas have changed over time, so this is a living system. As you hear new research, as you test new research, you change things. So I'm really looking forward to your presentation. Before I let you go, I want to remind our audience that we are recording the presentation tonight. So you know, be rest assured you'll be able to see this again tomorrow, and it'll be available on our YouTube channel. I'll be here listening for questions, so please go ahead and type your questions into the questions panel. And Charles, I think, are you going to be stopping a couple times perhaps to answer some questions, or are you going to do it towards the end?
Yeah, I'll stop halfway through. After we get through value momentum, I'll stop and take a few questions, and then we'll move on from there.
Okay, very good. Well, thank you so much, Charles. I'm going to turn my camera off, turn it over to you, and I'll be looking at the questions very anxiously.
Great. Thank you, John. Good evening, everybody. Thanks for joining us on the summer night. I know it's a hot summer night in many areas of the country, including here in Chicago. Had a conversation with somebody today in Austin. They said it was over 105. Having lived in Houston, I'm well accustomed to the Texas summers. But today we're going to heat things up in a different way by talking about how to truly be an active investor. And so let's just start off with the idea of what a truly active investor is. I'm not talking about the frequency at which you trade. I'm really talking about selecting stocks and really taking an active approach to selecting stocks. And so it really, and from the standpoint of being an investor, it really is a strategy that deviates from the indexes. So you're not trying to track the indexes, you're actually trying to build a portfolio based on traits that aren't necessarily used to construct an index, particularly your major market cap weighted indexes. So a very big distinction. Sometimes people think active is trading, but we've shown with our shadow stock portfolio, which is a very active approach, has very few trades. Now VMQ is more active in terms of its trading, but our goal is to be different than the index. And why do we want to be different than the index? Well, I'm going to tell you right now that if you want returns that are close to what the index does, buy an ETF. You can buy the Vanguard S&P 500. iShares offers one. State Street offers ones with their SPDR products. There's other ones. These funds are very effective at what they do. For a very low cost, you can get the returns of the S&P 500. And if that's what you're comfortable with, that's great. But what I'll tell you is that while the index funds are really good at what they do, they'll never beat the index. They're designed to mimic the index, not beat it. And if you want to beat the index, then your portfolio should look nothing like these ETFs and these mutual funds. And although you can say, well, I can buy an actively managed mutual fund, the reality is a lot of these mutual funds are what are known in the industry as closet indexers. They're basically S&P 500 index funds with a little twist here and there, but a higher cost. We know this when we look at measures like the R squared. And it basically measures how much of a fund's returns can be explained by movements in the S&P 500. And for the average domestic actively managed fund, over 90% of them, most of them actually have a R squared of close to 90%. In other words, 91% of the returns can be explained by the S&P 500. So you're paying more to basically get the index's returns, because even though these funds describe themselves as being active, they're actually not that active. And there's a simple reason for it. Most fund managers are being compared to a benchmark, especially for large cap funds. It's the S&P 500. And so if you're a large cap manager, you're faced with what's known as a money manager's dilemma. They can do either what they know works over the long term in terms of building long-term wealth, in terms of beating the market over the long term, or they can keep their clients happy. A lot of your institutional managers, a lot of your fund managers actually get evaluated on 3-year performance. How have they performed versus their peers and versus the indexes on a 3-year period? So even though we hear about long-term investing and how important it is and about the smart money, well, the so-called smart money, your pensions, your endowments, your institutional investors, they're weighing these fund managers based on 3-year records. And if you think that I'm making this up, I will tell you I've been in conferences where I've seen people talk about strategies with really good long-term performance, like value. And I've heard people in the seminar, in the audience, looking at the speaker saying, I understand everything you're saying. I completely agree with everything you're saying. But if I underperform for a short-term period of time, I'm going to get fired. So what does this mean for you and I? Well, even in a realm where we're seeing indexing on the rise, it creates opportunities for us. Because as individual investors, we have 2 big advantages. The first is we never have to report our performance. The second is we're not bound by investment objectives. We're not required to invest in large cap stocks. We're not required to limit our exposure to small cap stocks. We have the ability to walk around the entire buffet that is exchange traded stocks, pick which ones we want, and oh, by the way, we never have to tell anybody how we're doing. I cannot stress with enough emphasis how big an advantage it is to never have to report your performance. It gives you the ability to go after these strategies that have worked over the long term, but may incur shorter term periods where they underperform. It gives you the ability to stick with them and reap those really long-term gains. What factors work is well known. The academics are publishing it regularly. You can go to Kenneth French's database. Just type in Kenneth French database into your Google search engine. You'll find his database. The data is there about what's worked over the long term. And even though it's wide open to the public, most of your professional money managers don't use it to their advantage because they're so worried about having a very short-term period of underperformance. So realize that even though the so-called smart money is given to institutional investors, we retail investors have the ability to take advantage of things they can't do, and that actually gives us the ability to actually go after smarter investing strategies. So if you're going to be an active investor, what do you need to think about? Well, one, base a strategy on what's worked historically. Do we know what's going to happen over the next 5 or 10 years? No, but we can look at a lot of decades of market history and know that over time, these certain things have played out. And over time, we know that even when things have gone astray, that what has worked on average tends to continue to work on average. You should also have a systematic, well-defined approach to investing. Our founder, Jim Clunan, emphasized this. And again, you also should be willing to sacrifice short-term underperformance. And I realize that can be uncomfortable. And if you have needs for shorter-term cash flows, you need to build that into your strategy. But that's a price to be paid sometimes to get longer-term returns. Now, if it does make you nervous, you could combine partially passive with partially active. There's no right or wrong here, but realize to be a true active investor means you're going to have returns that are different than the S&P 500. That means you're going to have years where you outperform it quite a bit, but you're going to have some years where your returns aren't so great, and you just have to be comfortable with that. And that comfort level does vary with every individual investor. What I will tell you is you're not going to beat the pros at just buying the S&P 500. You can buy certain large cap stocks within the S&P 500, but if you really want to do better, you really need to think about being different. And VMQ is one of those approaches you can use to be different than the market. It's based on two cornerstones, value and momentum. And why did I base a strategy on these cornerstones? Because over time, both of these factors have worked, and they've worked really well. I'll start off with value. Value works because it beats growth. There's this common misperception that if I want higher returns, I need to buy growth stocks. And over shorter periods of time, growth can beat value. But it doesn't matter what multiple we look at, price to book, price to earnings, price to cash flow. We can use price to sales. Low valuations beat high valuations over the long term. Why is this the case? Well, I like to boil it down to a simple formula, that when a stock's doing well, it's getting a lot of publicity, people are going to flock to it. That pushes up the valuation. The simple laws of supply and demand. You have a set number of shares, and when the number of shareholders interested in owning those shares increases, you see the share price rise. So why is the share price rising? Well, people are having greater and greater expectations. They think the company's going to continue to do well. And what happens is you can have a very good company, but if investors are expecting great earnings and the company reports just very good earnings, you're going to have this gap. And that little gap where the company reports good earnings, but not good enough to meet expectations, the stock price can fall. This gives your highly valued stocks more downside risk. With value stocks, you often don't see this. They often trade at lower valuations because people aren't so optimistic about them. So when they report good earnings, they catch people by surprise and you can see the price jump. But we often see a lag in that reaction. We'll see some investors turn their heads and go, oh, that stock's actually doing better than I expected. And someone will buy, but then a period of time will go by and not everyone's bought in, and then they'll report good earnings again, and it starts to build. So if you've ever looked at a chart of the stock, and you've seen the stock, reach a bottom, and then you've seen it rebound by quite a bit, and you thought, I really should have bought the stock when it was near its low price. Maybe you're a value investor and you just don't realize it. So value investing is really trying to buy assets at a price below what we can reasonably expect someone else to pay for it in the future. And keep in mind, we do not need a price target. We don't need to know what number we're going to sell a stock at. So say the stock's trading at 20, we don't need to know that the stock's worth 30. We just have to know at $20 per share, that stock's valued pretty cheaply, and it's reasonable to assume that it should trade at a higher price. So how do you value a stock? Well, there's a couple ways you can do it. The academics like to use relative valuations. And we're going to talk about these relative rankings a little bit tonight. But in very simple terms, it's placing each stock into a percentile. So in value, you're valuing from low to high. So stocks with your lowest price to book ratios, your lowest price to sales ratios, lowest PE ratios, etc. We'll assign them the lowest percentile ranks. So they might have a percentile ranking them in the lowest 10%, lowest 15%. The stocks with their highest valuations, stocks may be trading at a PE of 100 or price to sales of 20. Those stocks will have very high relative valuations. And so we might put them in the upper percentile ranks, maybe a percentile of 80 or percentile of 90. So the higher the percentile rank is, the more valuable they are. Now, if you're in favor of reading, say, Benjamin Graham's books, where he's talked about a price to book of no higher than 3, price to earnings no higher than 20, you're using absolute valuations. So this means you're looking at what the valuation is. Is it a price to sales of 1? Is it a price to book of 5? Is it a PE of 20? Whatever that number is, that's how you're valuing the stock. In my original strategy, which I used for Better, Good, and Lucky, I used as absolute valuations. I since switched to relative valuations because it casts a bigger net. Either one works. The advantage about relative valuations is it doesn't matter what's going on in the market. It doesn't matter if the market's expensive or if it's cheap. You're always going to find stocks to buy because there's always going to be stocks that have a below average valuation. With absolute numbers, your screen could actually find quite a lot of stocks or not very many. For those of you who are familiar with our shadow stock portfolio, we do base those absolute valuations on the lowest 10%, but you do see periods where more stocks pass the screen and fewer pass the screen because it's using absolute valuation. One is not necessarily better than the other, but it just really depends. Do you want to cast a wider net, which in that case you'd want to use relative valuations. If you're happy having a narrower net, but you want to make sure you never pay above a certain absolute ratio, then you can use absolute valuations. But either way you do it, we do find it useful to combine valuation measures. And I know Wayne Thorpe talked about this a couple weeks ago, and we talked about factors, but I'll go over this again. We actually use 6 valuation ratios for our value grade. Price to sales, price to earnings, enterprise value to EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Basically adjusting earnings for charges that are management's discretion, some non-cash charges. It's a proxy for cash flow. Shareholder yield, which is the number, is basically the change in shares outstanding. Price to book and price to free cash flow. And so we look at all 6. Now, we don't require a stock to actually have all 6 of these valuations. We just require they have at least 2 of the 6. So the idea, again, we're trying to cast a wider net by making the value score adapt. Now, let me go back to the screen. When we first launched VMQ, we just used three. We used price to sales, price to book, and price to cash flow. And what we found was the screen could be very restrictive at times, and it was going to be a little too restrictive. So we went back and we looked at the research. We also looked at Jim O'Shaughnessy's research on composite valuations. And what we found, if we create a bigger composite, meaning that we consider more criteria, not only are we identifying more stocks, but we actually found it was more effective. It actually gave us a higher return. So the way our value score works is we require a stock to have at least 2 of the 6 valuation criteria. And then we use a 2-step ranking process. So first of all, we rank each valuation ratio. So this stock has a low price to book ratio, maybe it has a percentile ranking of 10 for that number, but maybe it's a high PE ratio. So maybe it has a percentage ranking of 60 for that. Then we figure out then we do the average of all those and compare the average of those to the average of all other stocks. So we're basically doing a composite ranking. We're trying to figure out which stocks actually have the lowest composite ranking of all stocks on a relative basis. That's how we're coming up with the score. So it's a 2-step process, a little bit complicated, but the big thing is we're trying to see, when we look at a combination of valuation ratios, which stock looks the cheapest relative to all other stocks. And when we seek to buy stocks, we're looking for stocks with below average valuations. We're essentially looking for stocks whose valuation score is in the lowest 40% of all stocks. Because if you look at the data and valuation, and it really is those stocks in the lowest 40%, the lowest 4 deciles that have the best outperformance. And our research into the value scores showed us to be true as well. Now, although value does work over the long term, like any factor, it can incur periods of short-term underperformance. And we've seen this for the past couple of years. When we look at 2017 and 2019, we've seen that value has lagged growth by a large amount. We can actually pinpoint the reason for it. It's your Google, your Amazon, your FANG stocks. What's been driving the market have really been your mega cap technology stocks. The largest stocks in the S&P 500 have been driving the valuations, have been driving the performance. So you've had this shift out of value and into growth. And certainly over the last decade, we've seen the S&P 500 perform really well. So some of you might be thinking, well, that doesn't bode very well for value. And for right now, the answer is no, it doesn't. But go back one decade, go to 2000 to 2009. That was the lost decade for the S&P 500. Value did really well over that decade. And for those of you who remember the dot-com bubble, value managers were under career pressure. You heard about them being fired. Warren Buffett came out and said, if anybody wants to sell their Berkshire Hathaway shares to me, I'll gladly buy them. Bubble crashed. All of a sudden, value was back in favor. So we see this on a pendulum where most often it's in favor of value. We see value doing really well, but at times it swings the other way and we see growth doing really well. But when we look over the long term, we see value beat growth by a large amount. And it's this fear of underperforming that makes value work. Now, some of you might look at this chart and think, well, that's a bug with value. That's a sign of why we don't want to get in value. But I would argue it's actually a feature. And the reason why I say it's a feature is this fear of underperformance. The more people are fearful of going after a factor or certain characteristics of stocks because they're worried about these bouts of underperformance, the more that factor is going to work over the long term. Because what often kills these traits, these factors, is they get too popular. But when they're hard to follow, you have the psychological impact where people don't want to necessarily follow them because they don't want to underperform the index. That gives these factors staying power. And that gives an advantage to us active investors, even at a time when index investing gets more popular, because it basically really pulls the band. If you think valuation is a band, value versus growth, when gets stretched too far, you have value being underperforming too much, it snaps back, and it can often snap back hard, giving you a lot of good performance. So this is why value works, because it can be hard to follow, but we also see an economic reason why it works, because people get too pessimistic on a stock's opportunities, on its potential outcomes, and because they're too pessimistic, they tend to undervalue the stock, which gives it more room to rise. Now, momentum, in some ways, is the opposite of values. Whereas value plays on people not being optimistic about a stock, momentum plays on our optimism. And so if you're a believer in the concept of efficient markets, meaning that all known information is priced into the stock, or the concept that Mr. Market is right, and that if prices are moving, it must be a sign that people know something, then you might like momentum. Momentum basically is buying the stocks that have done the best over a period of time. And what we found over the long term, surprise, surprise, investors like stocks that have done well. And it doesn't matter if you look at small stocks or large cap stocks. As you can see on the screen, they've done well. Stocks that have actually underperformed in terms of having weak momentum, meaning they've underperformed by the largest amount, and then the poorest. So in value, we talked about rankings going from low to high, where low is good and high is bad. Well, momentum is the exact opposite. So we're basically ranking the stock on how its return over a certain period compares to return of all other stocks over that same period. And what the research shows is that stocks that have outperformed the majority of all stocks, so stocks whose relative performance over a period of time ranks in the top 40%, meaning a relative strength index or relative strength score of 60% or higher, tend to continue to outperform. And this works when we look at periods of 13 weeks up to 52 weeks. Now, what's interesting, when you look at a 4-week period, a very short-term period, the performance is about average with the market. So it doesn't work over very short-term periods. When you start extending it out to, say, about 13 weeks to 52 weeks, we actually see that outperformance work really well. Now, the one thing I will tell about momentum is that although it works really well, it can have some volatility, and it can lead to more turnover. So therefore, when you factor in trading costs, it can be more costly. But we found that even with that excess cost, momentum can work really well. So how do we use momentum? We use what's known as a weighted 4-quarter relative strength rank. That's a lot of words. So let me explain to you what we do. Instead of just looking at how stocks performed over the most recent quarter, approximately 13 weeks, we actually divide the last 52 weeks into 4 different quarters. And then we assign a weight. So for the most recent quarter, we assign it a 40% weight. So we're giving a little bit more emphasis to the most recent performance. And then for each of the past 3 quarters, so consider quarter 1 the most recent quarter, quarter 2, quarter 3, quarter 4, we assign a 20% ranking to those 3 quarters. So we're considering how the stocks performed recently, but also considering how the stocks performed over the last 52 weeks. And when we tested this, we actually found it works better than if you consider periods of, say, 26 weeks or 52 weeks, a straight 26-week relative strength rank or a straight 52-week relative strength rank. So even though it's a little bit more complicated, we found it actually improves performance. Now, one thing I will tell you about momentum, although it works really well, like value, it undergoes periods where it can quote-unquote crash. And we most often see this when there's a bear market. And this is a study that actually tracks it. So let me walk you through this chart because there's a lot of numbers on here. So this is showing some of the 5 worst momentum crashes. And you can see 3 of these were during the Great Depression. So what it looked at, how the market's returns over the 2 years prior to that date. So you can see the market really, most times, underperformed. And then it looked how the winners versus losers performed. So basically, your winners were the stocks that were doing the best during the downturn. The losers were the stocks that performed the worst. And so what happened, if you look at row 1, when the market rebounded, the stocks that did the worst falling in during the bear market, the stocks that had the biggest decline, also rebounded by the largest amounts. So what happened was the stocks that were doing best heading into the bottom of the market actually underperformed by the largest amount going forward. And there's two reasons why, because when the market bottomed, suddenly you had a shift in preference for the bargain hunters, but then you also had people who were short selling the stocks. When the stocks were falling, they were selling the stocks short. So when the stocks started to rebound, they had to actually cover the short positions. So when you sell a stock short, for those of you unfamiliar with the concept, you're basically borrowing shares with the idea is that you're going to repay those borrowed shares by buying them back at a lower price. So as long as the price is falling, you're doing well, because if you borrow shares, say at 20, you're required, and you see about 100 shares, you're required to give back 100 shares to the person you borrow them from. So if you borrow those shares and then you sell them, and you're able to buy them back at $10, well, all of a sudden, you borrowed something worth 20, but then you're paying back that loan with something you purchased for 10. That's a really good deal. But if that stock goes, instead of going from 20 to 10, goes from 20 to 40, well, all of a sudden that stock you borrowed at $20 per share, you now have to repay at $40 per share. So this is why we sometimes see short squeezes occur, because these short sellers don't want to lose their shorts. And that's what happens with momentum, is that when there's been a big market crash, we see momentum actually outperform. So with the coronavirus, I'm sure a lot of you have that question, what happened afterwards? I don't have the data right now to actually tell you how that performed. This is an August 2014 study, and we don't have data right after the coronavirus. And plus, given the speed at which the coronavirus bear happened and the speed we rebounded, it may not be a long enough time to see this play out. But it is worth noting that, like value, momentum doesn't always outperform. And again, that's a feature, not a bug, because it keeps the factor from being too crowded. It keeps it from being too popular, which increases the odds of it working in the future. Now, the reason why I like to combine low valuation with strong momentum is I think it's a sign that it tells you other people are looking at a cheaply valued stock and think to themselves, hey, that's a bargain. I want to get in on it. So it's a way of using the market's efficiency, using the market knowledge that's out there to kind of confirm that what you're looking at might actually be right. So before I go into quality and show people how we actually use the VMQ approach to analyze a stock, John, have there any questions that have come through so far?
Yes, Charles. And first of all, I want to apologize to the audience. I know that Charles's microphone is coming in with a little bit extra static than I think it might be a measure of its bandwidth or whatnot, but sorry about that. Obviously, we'll see what's causing that and try to make sure in future webinars that's not an issue. Yeah, I mean, there's a lot of good questions here, Charles. I mean, first of all, going back to the beginning, when you talk about active investing versus passive investing, any thoughts? I mean, like when you think of someone like Charles Ellis and his book Winning the Loser's Game, he says active investing is a loser's game. Any thoughts about the rebuttal to that?
Not at all. Yeah, I do actually. And I respect Charlie Ellis. It's a great book. And Charlie's, when it comes to mutual funds, Charlie's absolutely right. And I think when it comes to active approaches, I also think Jim O'Shaughnessy, who's a very big proponent of active investing, is also right. And so it's not paradoxical. The difference is that you need to have a very systematic approach to active investing. You have to know what your strategy is, why it works, and be willing to stick with it over the long term and apply it in a very systematic approach. You can win at active investing, but again, you have to be very different than the index, and you have to be willing to commit to that strategy. We've shown with a shadow stock portfolio that over the long term, active investing can work, but you've got to be willing to stick with it. But one of the things Charlie Ellis points he made, that when you're trying to pick a mutual fund manager who's active, it's very hard to do to predict the ones that are going to outperform over the long term in advance. So it's not that Charlie's wrong, but you have to realize because the odds of outperformance are greater when you're active investing, you have to be very clear about what your strategy is and be very disciplined in applying that approach.
In terms of mutual funds, are you aware of any funds that kind of follow the VMQ approach?
It's usually on the ETF side. There aren't any that exactly follow it. I know Alpha Architect has a fund that follows it fairly closely. There's a couple others. To give you my email, it's charles@AAII.com. I had a few ETFs that follow a similar approach that I can certainly share with them. They don't follow the VMQ approach specifically, but they follow a general idea of how combining value with momentum. And I'll be happy to share some of their names.
Thank you. Small cap stocks and value stocks, obviously, as you mentioned, have had a poor showing in the last 10 years. So when do you think that they'll start to make a comeback?
That's a $64,000 question, John. But as you showed, and you actually showed, I believe it was in April in the AAII Journal, your shadow stock commentary, that when we look at the valuations of growth of large cap stocks to small cap stocks, we look back in April, it was about 2.0 relative difference in valuations. I believe we looked at price to book. Historically, it's been about 1.5. And it's not just us that noticed it. O'Shaughnessy Asset Management noticed it. A couple other firms have noticed it. So we're really seeing this pendulum swing too far in the side of large cap stocks. So it definitely looks like the time for small cap stocks to outperform is coming. We don't know when. There's an old saying in investing that reversion to the mean is a pain. And what it means is that when you do see the pendulum swing too far to one side, it tends to come back, and it tends to come back with a vengeance, meaning that people who ignore reversion to mean are going to get hurt really badly. But then again, those trying to wait for it to happen can also endure short-term pain. So we can't say with certainty. What I can tell you, though, is when you look at what's really driven the S&P 500, it's really mega cap companies, and you look at their market capitalizations, I'm not saying they're going to fall, but when you start figuring out, okay, how are they going to perform that well over the next 10 years, start adding in earnings growth and sales growth, it's a tremendous amount of dollars. And so you can start looking at things like that going, well, at some point, it's going to switch. Again, we don't know when, but the odds are saying that the time for value, the time for small cap, definitely seems like that their day in the sun is coming.
So I have a couple of questions here from members who are, in their 70s, and their concern is that, given that they're older, do they have the time to wait for value to come back, or do they have the time to wait for a system like VMQ to play itself out?
That's certainly a risk, and it really just depends on your investing time horizon. If you're 70, you have good health, you could easily be looking at 20 to 25 years of growth. You could also be looking at cases where you're looking to leave money for your heirs, in which case you should be investing aggressively, trying to grow it. But you certainly have to balance that with your need for portfolio income, and that really comes down to what your tolerance for risk is, and how much do you depend on your portfolio to provide income. And so that's really a personal decision. We can't give advice to every single person, but it certainly applies to the risk tolerance. And VMQ is a higher risk strategy. You are willing to take on more volatility to seek higher returns, and that's not right for every investor. Certainly a portfolio like our dividend investing might be more appropriate for someone who is seeking more portfolio income.
And then I'll ask one question here about the momentum, and I'll let you continue on with your presentation. Harry here agrees that momentum can work really well, but it seems to come with much more volatility. Any thoughts about that? Is it still rewarding?
It's still rewarding. It does, you're right. It does come with more volatility, and that's why I think having disciplined rules on how you're going to apply it does help. But it does come with more transactions. It does come more volatility. That makes it hard to follow. That scares people away, which allows them to continue working. So it's just part of the factor that investors need to be aware of. What research shows, though, is when you pair it with value, you do see some of the volatility actually being reduced and some of the turnover being reduced as well. So that's why we say value and momentum pairs really well together.
Very good. Well, there's a lot more questions. I'll keep them for the end of the seminar, and I'll let you continue on with your presentation now. I think the issue with the microphone might be more Bluetooth, or it's not the closest that seems to be the issue. You seem to be popping in and out. So we'll make sure in future webinars we take care of that issue. But again, it's thank you so much.
Sure. I apologize about the internet connection. I have it plugged into my router, but we're going to blame Comcast for this. So I'm going back to value momentum. So I've just said it worked really well. I want to show you this chart real quick. This is from S&P 500. This is from their index dashboard. And you can download this. It's updated monthly now. And it shows you how different factors work. So what they do is they take the S&P 500 and they break it into different subset indexes. In this case, the green box is a high momentum value index. So it's looking at the value stocks within the S&P 500 and singling out the ones with the highest momentum. And as you can see, over the last 15 years, it's done better than value and done better than pure value. Now, what's interesting is when we launched VMQ, a couple of years ago, the high value momentum was the best performing subset index of the S&P 500, and it outperformed the S&P 500 by a wide margin. Because we've seen value underperform, it's dragged down the performance of this index. But we know over the long term, this index works really well. But what we'll tell you about, if you only look for value and only look for momentum, you're going to come away with a large number of stocks, more stocks than you or I as individual investors can own. So you want to narrow down that list. And the way we do that with VMQ is we look for quality. We use quality really as a filter to weed out the junkiest stocks. So give us the stocks with a high momentum, give us the stocks with a low valuation, but then let's get rid of the junkiest stocks. Let's find stocks that have got another reason to rise in price. And so we do this by looking at 5 different quality characteristics. And we actually look at the stocks to see how many of those characteristics the stock passes relative to all other stocks. So again, we use this ranking process where we tabulate how many of those 5 traits a stock passes, and we compare it to how many of the traits all the other stocks pass. So we're not necessarily looking for stocks that pass all 5 traits. We're looking for stocks that pass more of those traits than most other stocks. So let me go back to this. I almost hit that little thing here. So actually, wow, it looks like the slide got deleted here. So let me walk you through this real quick. I apologize for that. I think some of the editing, the slide got cut out. But so we're looking at how stocks, we're looking for improvements in asset turnover, meaning that they're getting more efficient at using their assets to generate sales. We're looking at accrual. So accrual accounting has to do with the timing that earnings are recognized. So most corporations recognize earnings when a transaction has occurred. Were they use cash earnings, it would mean they'd recognize transactions when they got paid. And so what it means is, and so there's nothing nefarious about it, but what it means, if they're recognizing an accrual accounting, there can be a difference between the time they recognize the transaction and the time they actually get the cash. And so what accrual accounting does, in very simple terms, it compares net income versus cash from operations. And if cash from operations is greater than net income, it tells you that earnings are more persistent. In other words, earnings are less likely to be written off. And so we see these companies announcing big write-off to earnings. It often means they're overly reliant on accrual accounting. We look at earnings estimate revisions. So positive earnings estimate revisions have been associated with better performing stock prices. You can see this with the AAII stock screens, where our earnings estimates revised up screens tend to have the best performance over the long term. Our earnings estimates revised down screens tend to be our worst performing screens. Now, one advantage to using a ranking process for our quality scores than saying, does it pass all 5 of the tests, is earnings estimate revisions, because they tend to be calendar oriented. So right now, we're waiting for the bulk of companies to report earnings. And because we know a lot of earnings are going to come out in the second half of this month, we're seeing analysts being pretty quiet with their earnings. They're not making big changes to their earnings estimates because they're waiting for that new information to come out. So you can almost plot earnings estimates on a chart where when you get to the peak of earnings season, it rises, and then as earnings season ends, it falls back down because it's very related to the calendar. The other two traits we look at is dividend growth. Is the company raising its dividend? For those of you who have sat in Derek Hageman's webinars, you know that dividend growth is associated with outperforming stock prices. Dividend cuts can be a warning sign. And with share buybacks, I realize they're controversial, but companies that reduce the number of shares outstanding tend to outperform over the long term. Now, again, because we use our system, because we use a relative system, since a lot of companies did suspend buybacks in the second quarter due to the coronavirus, and even going back to March, our quality system is going to adjust for that. So the bulk of companies have stopped buying back stocks. Our system is going to adjust the rankings for the quality component to that. So that's one advantage of using a ranking system, is it allows us to still consider a broad number of stocks, but adjust the traits for it. So, but using all these traits, we still want to apply some additional restrictions. And one of the things I'll tell you, if you're going to be an active investor, and even if you're looking at this and going, I like the concept of active investing, but I want to tweak some things about your strategy, which is fine. Just think about what you wouldn't own under any circumstance. What stocks do you want to avoid? For us, we require stocks that are profitable. We want stocks that are making money. We do require stocks to be exchange listed and have a price above $4 per share, so they're not in danger of being kicked off the exchanges. We avoid Chinese and Russian stocks. Chinese stocks simply because there have been accounting problems in China in the past, so we want to avoid it. Russia, simply, I don't trust Putin. Simple as that. But there have been cases with Russia where the oligarchs have actually taken over Russian companies. There's a great book called Red Notice from a fund manager who actually tried to operate a fund investing in Russian companies. The oligarchs actually stole his companies, not his fund's assets, but the actual companies themselves. We do avoid ADRs and ADS shares simply because there can be different accounting statements and different accounting methodologies causing our system not to work with it. And the same thing with financial stocks, and the same thing with REITs. Parts of our value score, parts of our quality score doesn't work really well with financial stocks or REITs because their financial statements are different. So that's why we avoid them. Nothing wrong with either stocks. You just need a different method to evaluate them. So how do we put this all together? Well, we use our grades. So every grade you see for our value or momentum grades or quality grades, it's tied to quintiles. So 0 to 20%, 21 to 40%, 41 to 60%, etc. So for value, we're looking for grades of A or B, meaning that their value scores rank between 0 and 40%. So we want a low valuation. For momentum grades, we want a strong momentum. So we want the higher percentage rankings, 60 to 80%, 80 to 100%. So a momentum grade of A and B, and a value grade of A and B. So low valuation, high momentum. And then a quality grade of A or B. And so we use all this for our VMQ Stocks portfolio. You can see it at vmqstocks.com. And to give you an idea of how we do this, I'll give you a recent addition, Sprouts Farmers Markets. It's in 23 states. It's not here in Chicago, so I can't talk to you about personal experience about being in the store, but from researching it, I can tell you some pretty attractive things about this company. So this is a health-oriented store. And one of the things that it does is it actually devotes a higher than average square footage to fresh produce. So the big thing is we're going to help people live healthy. We're going to sell a lot of produce. They also do a lot of health-oriented goods, including vitamins. They also are shrinking. They're shrinking the size of their store. So their current store format's about 25 to 30,000 square foot. They're actually reducing it to about 21,000 to 25,000 square foot. To put those numbers in perspective, when we add the stock, I Googled the number. Your average grocery store right now has square footage of about 40 to 45,000 square foot. As you know, there are some of these super-sized grocery stores which are much larger. Here in Northern Illinois and certainly in Wisconsin, we have a store called Woodman's. It literally is the size of a warehouse. So Sprouts is actually going the opposite direction and going smaller. Now, some of you might say, well, that seems like that might hurt sales. But if you look at Trader Joe's, which actually has a smaller square footage, I want to say when I Googled, it's about 15,000 square footage. They're known for having some of the most highest revenues per square footage. So there is a model for actually going smaller and generating higher revenues. But this company is also revamping their marketing. They did an assessment trying to define who their core customer is. And the CEO says if they can just pick up additional 3% market share, they can double their sales. So an aggressive target, but you can certainly see, even though the VMQ portfolio doesn't specifically consider growth, you could see the potential for that growth. So even the CEO is off by 50%, 1.5%, they have an additional 1.5% share of their market, of their core market, still huge sales growth. And when we added the stock, it was cheap. It had a value score of 34, which equates to a value score of B. It had a momentum score of 91, which basically means bargain hunters are looking for it. It's the momentum score of A. They're paying attention to it. Now, part of that was because of the pandemic. What Sprouts farmers saw, as the other grocery stores saw, they actually saw a lot of people buying huge purchases, trying to stock up because they're worried about being quarantined. They're worried about you not being able to go to the grocery store. So that really drove the first quarter numbers. But it looks like the trends are starting to continue. And because they're revamping their marketing, hopefully they're capturing more of these investors. And we also added stock because its quality grade was an A. So what is the stock doing now? Well, this is from today. This is from our VMQ stock. We actually give you the value scores. We actually give you the details behind all those value scores. So if you go to our VMQ analyzer, you can actually see all the details. If you want to know exactly what's behind each of these these momentum grades, and these quality grades. So right now, Sprouts is still very cheaply valued. The value score of 31. It still has strong momentum. So momentum score is 84. And its quality grades is an A. It's a quality grade of 92, ranking as one of the best quality stocks, meaning it's passing the largest number of quality tests compared to most stocks. And you'll notice in the gray bar above the grades where it says Sprout Farmers currently qualifies according to the VMQ strategy. So what that means is the stock's in the VMQ strategy and it still meets our criteria for addition. So we don't sell stock because it no longer qualifies, but followers of our strategy, subscribers to VMQ, can look at our portfolio and see which stocks in the portfolio currently qualify for addition if they're looking for stocks to add. Now, obviously, if you're going to buy stocks, you want to sell stocks. And a very simple reason, you want to sell a stock when the reason you bought it no longer applies. Or simply put, when a stock has opposite characteristics of the ones you use to buy the stock, that's when you want to sell it. So for VMQ, what we want to do, and I'll go back to this. So VMQ, what we want to do is we want to sell the stock when the valuation gets to be high, when the momentum gets to be weak, or the quality deteriorates. And so the way we find stocks for this is we actually go through a list of candidates. And we actually find the candidates that have the best combination of low valuation and high momentum. And then we start at the very top and we look for red flags, because we have had stocks we've had to rule out, most often because they have a dual class share ownership. Some has majority control of the company. We have had found cases where the stock is either agreed to a merger, or in some cases we found stocks that are in the process of splitting off a large part of their portfolio. So for those cases, we might pass on the stock. But as much as possible, we try to adhere to the model. So the model says this stock has the lowest valuation and the highest momentum. that's the stock we're going to look at first. And so long as there's not a big red flag, we're going to own that company, or we're going to add that company to our portfolio. So before I take some additional questions, let me leave you with a few final thoughts. And again, I apologize for the audio issues. If you want to beat the markets, you've got to be different than the market. And that's what VMQ is designed to do. It's designed to get returns that are different than the markets. But to be different than the market means you're going to have returns that are going to be different as well. And that means you're going to have periods where you outperform by a lot, and you're going to have periods where you're going to underperform the market. I'll make an analogy that Cliff Ness, head of the hedge fund firm AQR, uses. He was quoted in the Wall Street Journal once as in 2008 for punching a monitor. And what Cliff likes to jokingly say is that, as I told the Wall Street Journal, they left out the most important part. The monitor had it coming. So when you're an active investor, you're going to have periods where you're going to feel like banging your head against the wall. But because you have that feeling, that's why these active strategies do work, because this risk of underperformance scares people away. And because it keeps the strategy from being harder for some people to follow, it gets more upside. So this upside comes from you being willing to do something that's different than the market. And if you have the ability to stick with it, you're going to do really well. Over the long term, you're going to get rewarded for that short-term pain. And the other thing I'll tell you is, so you see value, momentum, and quality being combined, you may not always know why the strategy is doing well or why the strategy is lagging. And so it's not as intuitive. And again, this is a feature, because there's a little bit of complexity keeps the strategy from being too popular. And if you want to be an active investor, you want strategies that aren't so popular, because that helps them keep their long-term premium. And I will say, for those of you who are interested, and those of you who are buying into this concept of being a truly active investor, we're offering a special $1 30-day trial to VMQ. You can go right here to tinyurl.com/VMQ trial. And the slides for today are downloadable. So if you didn't write this down, it will be on the slides. But I'll leave this up for a few minutes. John, do we have some questions that members have that I can answer?
We've got quite a few questions, so I think obviously we wanted to keep our presentation down to an hour, but we'll stay on for another 15, 20 minutes to answer questions here that have come up.
Sure.
So Charles, is there a minimum market cap for the stocks to be included in the pool of candidates for VMQ?
There is. So we looked at what we did for shadow stock, and we used that minimum of $30 million. We do have some volume constraints on it because we're managing a portfolio that other investors are going to invest in. We want to make sure the stocks have enough volume. So if we place an alert to add a stock, we don't want people unnecessarily driving up the price, our subscribers competing against each other. But in its purest form, you don't. So we set the $30 million just to make sure there's a market, enough volume to trade to the stocks. But we're really going low. And so this strategy is market cap neutral. We'll buy large cap stocks if they meet our quality criteria. We're not opposed to them, but we're really looking at what stocks have the best combination of value and momentum versus worrying, are they large cap or are they small cap?
You had a slide, I think it showed the 5 different worst momentum crashes.
Yes.
I had a couple of comments from our readers that they really were confused by that slide and your explanation of it. I think you'd have to go back to probably slide 20.
Sure, we'll go back to it. And so we did talk about the study in the journal too, so they can, let me go back to this here. Oh, I think I went right by it. Sorry about that. Clicking too fast. Here it is. So here's it. So again, trying to work through it. So basically, well, I'll go August 32. So you had a bear market when the market went down about 70% before it bottomed, and then it rebounded. So what you see here, and I'm tempted to point at like I'm giving a live presentation, so I'll avoid doing that. But if you look at the column winners versus losers, so the losers are the stocks that had the biggest losses going into the bottom. So when you look at 70% market decline, those are the stocks that actually fared the worst during that drop. The winners were the stocks that fared the best during the market drop. Meaning when the market was dropping, your losers were the stocks that lost the most amount of money, where your winners were the stocks that held up the best. Perhaps they dropped some, but not as badly. And so when you draw that bottom, then the researchers looked to see what happened afterwards. And they found that the stocks that did the worst going into the bottom of the bear market were the ones that had the strongest rebounding, meaning that they rose by the largest amounts. As a result, the stocks that did the best going into the bottom of the market, they actually underperformed by about 74%. So it's not that they fell by 74%, they actually underperformed going forward. But this study, we actually did discuss in the AAII Journal in 2014. There's a link to the study. I probably have it somewhere. Someone wants to email it to where I can actually give them the study as well if they want to read through it.
So what you could do in the show notes tomorrow, Charles, you'll include a link in the show notes then, is that correct?
Absolutely, I will certainly do that.
So what happens is whenever we do a webinar like this, we the next day we send out an email with links to the slides, links to the presentation, and then any kind of notes that come up like this. So Charles will have a link to help explain that particular chart.
Absolutely.
I had a member here who was concerned that this is too much. You're fine. Excuse me. This sounds like too much like a day trading strategy. Any thoughts about that? Any comment about that?
Yeah, it's absolutely not. So first of all, when we add a stock, we always do a 6-month probationary period, just to prevent excess trading. But it's not. It is more active than, say, a dividend investing portfolio. But we've had stocks. I'll give you an example. We just issued an alert on Monday to sell Rocky Brands. We held the stock for 2 years, actually for 2 years, almost to the day of the addition. We've held Target for over 2 years. So we do have some stocks we're going to be trading more frequently, some that we're going to hold on for a while. So it is not a day trading strategy. It is more active, but again, we've actually taken some steps to control the amount of times we actually have stocks coming up for sell alerts. We have a 6-month holding period. We found when we changed the momentum to the weighted fourth quarter, that also slowed down the number of alerts we got to sell stocks as well. So it is more actively traded, but we're not looking to get out of stocks every week or every month. We do want to try to limit transactions. I'd say this year we've been averaging about 1 transaction per year, and that includes, we do have some of our transactions have come from acquisitions. We've had 5 stocks since we launched the portfolio in a little over 2 years be acquired. But again, this is not a day trading strategy.
Question here from Michael. So, he's observed that, there's been a tremendous growth in the number of factor-based strategies, smart beta strategies, all these quantitative approaches. Has that impacted any kind of advantages that individual investors might have in the marketplace?
I don't think it has, and part of the reason I say that is they use the term factor zoo, but there's a lot of different factors out there. There's differences in how they apply them. The other thing is you look at a lot of these factor strategies, they tend to concentrate more on the larger stocks, particularly because they have to be concerned about making sure they have enough what's known as liquidity, basically enough trading volume in these stocks for them to actually invest in them. But if you look at the data on factors, particularly, and we'll have this in show notes, Ken French's database, but these factor premiums really work well down the spectrum. And we see momentum actually work better with smaller stocks than with larger stocks. So even with the explosion of factor investing, we're still seeing a lot of these funds, a lot of these strategies focusing on the larger stocks, which still leaves a lot of room for the mid and your small cap stocks being available for us individual investors to consider and still reap higher returns.
I guess the biggest challenge really is, if you think about it in some ways, is that, sometimes these factors, as you pointed, underperform other factors for long periods. Could be 10 years, could be as much as 15 years or even 20. And I guess that tends to shake out the weak hands and almost causes a reversion to the mean. Would you say that's part of the issue?
And absolutely. I think when you look at these factor strategies, if you're being hired as a consultant, or you're being hired by a manager to advise a big institutional investor, and you're saying, you know what, I think you should really follow this value strategy, or maybe you have follow this quality strategy, some other factor, and that factor underperforms for 3 years, there's a good likelihood you're going to get fired, or you're going to see the amount of assets allocated to you decrease. And again, that works to our advantage as individual investors, because we don't have to worry about that. So that keeps some institutional investors away from the factors and keeps the crowd away. And as investors, we don't want those crowds. We actually want them to stay away, because that really enhances the premium.
How many stocks do you have in the VMQ portfolio normally?
We keep the portfolio at 20 stocks. We recommend investors who are following the strategy to own at least 10 to get diversification. We like holding 20 because we think it provides more diversification. And if you think about it from a portfolio standpoint, the fewer stocks you have, the more one stock can move your portfolio in one direction or another. So if you have 5 stocks, each stock is 20% of your portfolio. So that one stock takes off, that's great. But if you find out for that one stock the CEO is cooking the books, that's very damaging. And so that's part of the reason why we recommend investors do hold at least 10 to 12 stocks. And while we actually see our portfolios really range between 20 and about 30 stocks to get some more diversification at the individual stock level.
So diversification is the one true free lunch that Wall Street provides investors, right?
Absolutely.
A number of questions have come up asking how is VMQ Stocks different from the Stock Superstars report, and are the two complementary?
No, that's a great question. There's certainly some overlap. So VMQ is a very specific factor-based portfolio, and we really focus on the value and momentum strategies. The Stock Superstars report is really a blend portfolio. So it's looking at 4 different gurus to actually apply and interpret their strategy to give you exposure to 4 different strategies. So you can really think of VMQ as your academic-oriented, quant-based strategy, where Stock Superstars is your guru-focused strategy, where it's really looking to apply these guru-active approaches. There is some overlap specifically between VMQ and the Shaughnessy approach and Stock Superstars, but they are different portfolios. Someone who's looking at our 4 approaches and really wants to build a diversified portfolio, Stock Superstars and VMQ are probably the closest. You could conceivably substitute VMQ for group 3 and use the other 3 strategies in Stock Superstars, or you could pair VMQ, say, with dividend investing. But there is some overlap, but they are still different.
Harry here from Los Angeles notes that he's gotten to Sprouts Farmers Market stores, and he finds that they have good food. The stores are clean, but their prices aren't necessarily the lowest around.
Well, thank you, Harry. Love hearing the feedback.
What kind of back testing has been done of the system?
So before we launched VMQ, we actually back tested it going back to 1998, and we did it through 2017. And what we found is they actually handedly outperformed the S&P 500 in its original form. Since then, we changed the momentum strategy. We found that worked well. Then when we did the value strategy, we actually looked at how the new value score did by itself. We found that lended to the outperformance. So we did test the entire VMQ with a new value methodology. We expanded the criteria from 3 to 6. But we have found, so we changed the strategy in April, VMQ has outperformed the market by quite a lot. But what I will say is a lot of the outperformance did come right when the market was rebounding from the coronavirus bear market. So it's a short-term horizon. And as much as I would love to brag, and we have actually outperformed the markets, the market's bottomed. And even if you compare how our portfolio long-term has done versus the S&P High Momentum Value Index, we're outperforming that since inception. We do not have back testing showing how VMQ works with this new value methodology, but we have every reason to believe it's going to continue helping performance over the long term.
A number of questions have come up. They see you using certain grades, like AABs and for value, momentum, and quality. And we've got a couple of A+ investor subscribers here. How do the grades differ between the two services, or do they differ?
They don't differ. We actually use the grading system of VMQ to base it for our A+ investing. So A+ investing has more grades. For instance, it has a growth grade, which we don't have in VMQ because those are very specific portfolios. So what we did with A+ investor is we really expanded it. And the way to think about the two is that VMQ is giving you a specific portfolio you can follow. And you can really look at all our model portfolios, whether it's VMQ, shadow stock, stock superstars, dividend investing. It's really for those who want to have a guided portfolio to follow, or at least want to have a strategy they can look at and say, okay, I like the strategy, I want to use it for ideas. A+ is really for the person who's a true do-it-yourself or really wants to build their own strategy, doesn't, really wants to go about and pick the stocks themselves versus following a portfolio. Both are great products. You can use both actually, where you can actually have the portfolios, use A+ as well. We're actually going to unveil a product and then very soon we have access to all of them. So if you want to pick and choose from our quote our model portfolios, but also have the ability to skin A+ for your own ideas, you're going to have that ability for a single price. But the way to think about it is these portfolios are more of a guided for people who want a guide saying, here's what we're looking at, where A+ is, let me roll up my sleeves and dig into the data myself.
Let's see here. For someone who's only familiar with index fund investing, how would one best implement value stock investing?
So there's two ways of doing it. If you really like the idea of investing in index funds, you could actually buy value-oriented index funds, either ETFs or mutual funds. They exist. You can also complement your portfolio by using an approach like VMQ, where you segment a certain portion of your portfolio, and that's your active approach. And that's a very acceptable approach to do it. And that's really what I use my own personal portfolio. Our 403B plan, a retirement plan at work, is through Vanguard. And so I'm using the index funds for this. But then I use VMQ, and I do use the VMQ approach myself for my active strategy. And so you could actually segment your portfolio to passive versus active. And what percentage should that be? There's no right or wrong answer to what your comfort level is. But the idea is you just segment a certain portion of your portfolio, whatever is appropriate for you, and that's what you use to do active.
Question here from Brian. How do you make valuations on small caps? Sorry, my screen just moved on me. How does one read? How does one make a valuation on small companies?
Yeah, I just think it's just I think in terms of valuation, it's just the same as large cap stocks. We're just looking at the valuation ratios, and we look at how they did historically. Now, if you're looking at the business side,
if I could follow up, I guess he's wondering what impact does the government bailout have, and potentially in today's market environment.
So it's a two-part question. So with valuations, we're evaluating small companies the same way we do large companies. We're quantitative based, so we're really looking at the numbers. But then I just for red flags with smaller companies, you might see them more controlled. So I do go to the SEC's EDGAR website. I look at Form 10K, which is their annual filing, to see if there's controlling ownership, because we do see that more often with small companies. So that's the one thing we need to pay attention to. You might see smaller companies less in charge of their end markets, which can be a business consideration for some. We don't worry about so much. But in terms of the government bailout, we've really seen it less from publicly traded companies and more from closely held businesses. A lot of the large publicly traded companies have been a lot of pressure on them not to do it so much. So we haven't seen that being a factor at play yet. It probably has more to do with their suppliers, perhaps their customers. Long term, we'll have to see how the bailout plays out, whether or not there will be a second bailout. That's still a big question mark. I think it's too early to say what effect that's going to be. What we've seen so far in our portfolio companies, however, it's really more to do with the pace we're seeing places reopen, businesses get back to a more normal business cycle, and obviously whether or not there'll be another shelter-in-place orders, another more shelter-in-place orders going out. Hopefully, we'll see the corona cases go back down as a temporary blip, but that's an unknown that we're all facing as investors.
So I have time for just a few more questions here.
Sure.
How many stocks normally pass the screen, and do you have a sense for the turnover?
Sure. In terms of the number of stocks that pass the screen, it varies. We've seen it get down to about 40 or 50. We've also seen around 80 or 90. When we changed the value score, it actually gave us a wider net of stocks passing. Before that, we actually saw some of the stocks, the passing list getting down to about 20. So with the range we've seen, really, I'd say over the last 6 months has really been about 80, 90, probably 50 and 90. So pretty good list. I think right now, I want to say we're approximately about 50. I'm going off memory. I'm actually going to look at the list tomorrow because we're going to add a new stock on Friday to replace Rocky Brands. Haven't decided which yet, and so I'll see that. But in terms of turnover, we see less turnover than people might expect. I do look at what industries are passing each month. I do write in my commentary. We've seen a lot of consumer discretionary stocks be the dominant sector for quite a while. We've seen home builder stocks such as Meritage Homes, which we do hold in the portfolio, have actually been on our qualifying list, our VMQ ideas list, for several months now. So we do see some stocks come and go, but we do see some stocks really stay qualifying for quite a long period of time as well.
And I guess as a last question here, how does AAII VMQ send alerts if any stocks in the portfolio has a change in the VMQ ratings?
So we do a few things. You can actually track the portfolio with my portfolio. You'll get alerts through that. You can also track the VMQ portfolio with your portfolio. On the VMQ website, on the home page, we actually show all the grade changes. So, if there's been a significant grade change, you can see it on the home page. You can see in the VMQ portfolio itself. But what we try to encourage people is don't really get worried if it goes from an A to a B or a B to the C. That'll cause you to have much higher turnover. We're really looking for stocks that have gone from having a high valuation, going from having a low valuation to a high valuation, or strong momentum to weak momentum. And as we see a stock approaching the danger zone, we'll actually tell you that the stock's nearing that danger zone on the VMQ portfolio. And as I'm running the weekly commentary, if I see a stock that might be at risk of violating one of our sell rules, I'll give you advance notice. This stock's approaching its value limit. We had this with Target for a while, where Target's done very well for us. Held that stock for a few years. And there was a period of time where we actually saw its valuation getting higher. That's no longer the case. Target's value score is about 50, 55 right now. So it's not there, but we will tell you when a stock's potentially nearing a deletion alert.
Well, thank you very much, Charles. It was a very informative presentation, and I'm looking forward to seeing your next buy for the VMQ Stocks portfolio. I guess you'll be announcing this Friday.
I'll be announcing it Friday afternoon.
Excellent. Thank you so much. And you've been on 2 weeks in a row now, so thank you for doing that. And then, if you wouldn't mind advancing your slide just once here.
Sure.
So we've got some webinars scheduled coming up. Next week, we're going to have Wayne Thorpe. He'll be back in the driver's seat, and he'll be doing a presentation on investing with a value investing guru with a twist. And I'm pretty sure that's David Dreaman. David Dreaman is a deep value investor, and he takes a look at how one can use things like earnings estimates to help increase your performance. And then I'll be back here July 22nd. I think it's a day before baseball begins, a day or two before baseball begins, so you can get some entertainment here on the web. And I'll be talking about the AAII Shadow Stock portfolio and I'll be talking about the genesis of the approach, how we came up with the rules, and how one can go ahead and use a quantitative approach to pick a microcap value portfolio. And then Derek Hageman will be back here on July 29th, and he'll be discussing the dividend investing service and how it works, how it operates, and run people through the basic choices of how one goes ahead and picks a dividend growth portfolio. So thank you very much. The webinar tonight was recorded. Tomorrow I'll look for a email in your inbox. It'll have a link to the video recording, and as well as any kind of show notes that would be links to information that was mentioned by Charles in tonight's show. So thank you so much. And if that was Derek, I'd say I'm wishing you green arrows, but I'll still wish you green arrows. Thank you.
Thanks, John.